Hi everyone, my name is Peter Elam Håkansson and I'm the Group CIO for the East Capital Group. With me today I have Grapengiesser, who is CIO for all the East Capital strategies. This time we're going to speak about the global emerging markets, and this is number 4 of the webinar series which we have about on the outlook for the coming year. So Jacob Grapengiesser, nowadays based in Hong Kong, where a recent move, and Hong Kong will of course not only be your base, sort of where you will be working from, but will also be the traveling base, and from there you will explore more parts of China. Only this week I understand you've been both in Beijing and Shanghai. Can you give us some quick reflections and impressions of the first time on the ground in China?
Yeah, thank you, Peter. So today I'm in Beijing. I'm here for a one-day stop just to take the pulse and meet some of the real estate and IT companies here. Unfortunately, I, together with half of Beijing, will be going to the airport tonight, so I'm not looking forward towards this 3-hour trip to the airport, but that's my problem. Overall, of course, the impressions from China are that it's not that easy to understand. I think that, if you use the classical emerging markets mindset, you simply be confused. Shanghai is one of the world's most expensive cities, and if you think of New York and you just take 5 Manhattans, that's roughly Shanghai. Super big, but also super wealthy in terms of the people who live there and what they consume. So, gone is this picture of China is this relatively poor country, but producing a lot of things. I mean, China today is a modern country with a high price level, and they are no longer producing plastic toys. I mean, they are producing solar panels and what you need for today's world. It just completely changed, and I think that's important to keep in mind when you think about China. Looking at other emerging markets, maybe it's a bit different. So yeah, I think if I get back to my first impression, I had a breakfast yesterday with John Waldron, who is the president and global COO of Goldman Sachs. I mean, he's the number 2 guy at Goldman, and Kevin Snyder, who is the ex-CEO of McKinsey. He's now also with Goldman. And I wasn't actually aware, how deep Goldman was integrating with the Chinese leadership, and how much of so he was here with Hank Paulson, who was also then in town, both in Beijing and Shanghai, and I wasn't aware how deep they go in terms of cooperation. And I think the first conclusion is probably that US and China, they both mean business. So all of these headlines you're seeing about geopolitics, yes, they are true, but underneath all of that there is a lot of business activity going on, and I think both sides realize that this is kind of headline rhetorics, whereas in reality, business kind of needs to move on. I think the second conclusion is that China is not going to be a 6 to 7% GDP growth type of market. It's going to be 3 to 5%. Having said that, that's still good. China, for very many years ahead, will be 1/3 of global growth, year in and year out. So of course, if you want to invest into growth, you just simply need to be in China. On the geopolitical side, well, I think it's hard to judge, but I think that the people I met on a relatively high level here, they are saying that we're probably close to some sort of rock bottom now, and things will improve. Again, it's hard to tell, but that's what the sort of sophisticated people that I'm meeting here are telling me, at least. I think a final maybe mental note you can make on the real estate sector here, and I think this is the key question, because it's so much money tied up into real estate. You saw today that one of the big developers, Evergrande, was halted in terms of trading in Hong Kong. I would probably say that you'll see more troubles ahead on the residential side, but that was also kind of a bit of a dirty sector. There was maybe money being paid left, right, center. Maybe they overbuilt in certain places, etc. So other than that, the Chinese economy is healthy and stable, and I rather think that the government here, they will not make a big bang in terms of stimulus to the economy to push economic growth towards 5-6%. Rather, they will do a lot of incremental steps. If the Fed moves the rate 75 bips, here the central bank moves the rate 15 bips. We're at around 4% now, so they will just cut it, the interest rates by 10 bips, 15 bips, but they will continue doing that for, I think, quite a period of time. And that, of course, would provide relief to the real estate sector, but it also means that the discount rate is lower, and hence stocks are worth more, right? If the discount rate is lower, and now if you get 4% on a bank deposit here, if you get in 1 year's time maybe 1-2%, then also stocks, the local stock markets become more attractive.
Okie doke, thank you. And I will go back to the topic actually, which we sent out in the invitation. So with rate hike cycles reaching an end in many emerging markets, the focus is shifting to underlying economic and earnings growth, valuations, and potential weakening of the USD. So this is normally a time for emerging markets. That's the perfect backdrop. How do you see it?
I wish it was that simple.
Indeed.
I think, unfortunately, it is all about China, and it is all about geopolitics. I mean, that is going to be the key driver for emerging markets. And don't forget that Taiwan and Korea are quite linked to and correlated with China. And if you put all of these together, that's 2/3 of the emerging market index. So I would say that the issue and what everyone is thinking about is China invading Taiwan. I don't think I'm the best person to forecast this, but I think that there's a large discrepancy between what the Western investors are thinking and the people that I'm meeting in Shanghai and Beijing. I think for them, they just think that no, I mean, there's not going to be an invasion. Yes, these thoughts are there. They want to reunite. Maybe in 20 years' time, something will happen. But no one here thinks that there's anything imminent. Again, this is what I was being told here in the past couple of weeks. But if you assume that nothing happens, which again I don't think, then investors will start to look at the fundamentals. And if you have stocks trading at 5 to 7 times earnings, especially actually Chinese stocks listed in the US, but these are very large companies, then it's just inevitable that stocks will go up, right? I think investors were selling stocks indiscriminately because of geopolitics, not looking at the valuations. But now when things are a little bit calmer, and I think that they are, then investors will go back, look at the fundamentals, and then I think slowly emerging markets will turn upwards. This is a too big part of the world to simply be ignored. If you look on the slide here, you can see that India and China together are half the GDP growth of the world. I mean, you just can't ignore that. You can ignore it for a while, 6 months, 12 months, but at some point you need to invest into that growth, right? Because that's what every investor wants to be part of, at least with a certain portion of their portfolio.
Exactly. That's good to hear. And actually, on the same graph, there's another interesting part of it, which is a bit kind of about the maybe least liked market in the beginning of the year, the LATAM market. Do you want to touch a bit on that?
Yeah, so I think emerging market as an asset class is very much dependent on China. Our strategies is very much based on stock picking, and of course we know all of these countries individually. In Brazil, we have 3 out of 4 companies delivering an EBITDA growth between 50 and 100% for the second quarter. I mean, crazy good results. And if you look on the country overall, it was upgraded from around 75 bips in terms of growth expectation on a GDP level this year to 2.5. And the central bank actually started to cut rates. So we're in a different point of the cycle in emerging markets. In China, we have very low inflation and declining rates. But in a country like Brazil, we had quite high rates, 13.75%, and they were recently cut to 12.75%. But of course, they will continue to cut the rates in Brazil, which is a good thing for the market, and quite a few of the companies in Brazil are actually quite levered. So this has a big impact on the profitability.
Thank you. You also mentioned briefly India. Can you say a couple of more words about that market, please?
Yeah, so we approach all of these markets quite differently. As I said, China is just a game on its own. But for India, we have this classical emerging markets style where people want to have a better life. You have GDP growth for very many years ahead, 6, 7, maybe even 8%. And we do have a slide actually here on India. For example, we had a company called Varun Beverages. It's quite a simple business. They just bottle water and Pepsi drinks. But as you can see here, the company went up. I think since we bought, we made 500% on the stock. We since sold because that at some point you need to sell as well. Just now, actually, these days we bought a new company called Graveta. They want to be one of the top 5 recycling companies in the world by 2026. This fits into the sustainable strategy of the fund clearly, but it's only a $660 million market cap, trading at 18 times earnings. Can this company go up a number of times in price? Yeah, I think it can. It won't happen tomorrow, even though the stock was up quite a lot in the past couple of days. But if you take a couple of year view, so I think in India we're aiming quite high. We're aiming for these companies that can give us hundreds of % in return. You need to be patient, you need to accept volatility, and you maybe also need to accept slightly higher valuations in India than in other emerging markets.
True. Another topic which we always find fascinating here at East Capital is the renewables theme. And that's been a kind of interesting ride this year. Could you expand a bit what happened there, please?
Yeah, so I think there's no doubt that renewable energy is needed, and we will see this multiple $1 trillion transition from fossil fuels to renewables. I think we knew renewables quite well. I think we look on so many companies in the sector. We have visited so many of them, and part of the reason why I'm traveling now in China is to get more familiar, and even some of these like factories far away, I will go there. But sometimes when you have these growth companies, you also take a big hit because there is no investor confidence. I think there was a lot of geopolitics. The US effectively stopped buying Chinese-made solar panels. A lot of countries realized that this is a strategic resource. We want to have our own solar panels. And to cut a long story short, most of the companies in renewables, especially solar, but also wind, went down 50 to 70% in the past 12 months. That was a hit to our portfolio. I think we lost 5% alpha because of this, because it was the largest sector in the fund. That was painful. Having said that, we have seen some of these stocks started to recover, and I certainly think that the long-term theme is there. I mean, this theme is not going to go away. And some of the companies in renewables with 30-50% growth are trading at 3, 4, 5, 7 times earnings, which is obviously too cheap.
Now, we are strong believers of this theme, definitely, and we're also strong believers of ESG. Can you talk a bit about how we see that both increasing returns and reducing risks in our portfolios?
Yeah. So first of all, I'm very much a performance-driven CIO. I think that clients, they want to see returns, but of course I want to deliver those returns in a sustainable way and decrease the risks. So that's what ESG is about for us, or for me. I think first of all, more and more money is flowing towards sustainable investments. So if you can be a little bit ahead of the crowd, if you can own those companies before other investors discover them, that's probably a good thing, and that will probably give you a little bit of outperformance over time. Secondly, the sustainable development goals matter probably more for emerging markets and developed markets. Global warming, meaning that you need renewable energy, is a bigger issue, right? More people die in India every year than in Germany of the effects of global warming. So it means that the development of solutions providers for the sustainable development goals will happen probably faster in emerging markets because there's simply a larger need for it. This is why China, for example, is producing more than 90% of the world's solar panel. If you want to invest into this, you need to invest into China. That's it. You know, maybe you can find some small producers somewhere else, but you know, the bulk of the production will be here. Thirdly, we buy a lot of interesting stock picks, but I think, you know, knowing your company, having a high ESG score, and we do very thorough ESG work, it decreases the risk level, which is important in emerging markets. And finally, so the way we work with ESG is that it is the portfolio manager or the analyst that does the heavy lifting. They themselves spend a day going through all the ESG aspects of the company. It might not be the most fun day of the week because it's typically one company per week, but it's a useful day, right? It gives you a different perspective. You see the dirty kitchen for this particular company, and it probably helps you to analyze the company in a better way.
No, true. So we are coming to the last question actually here, and I just remind we have a Q&A session as well, and I see there are already some questions in the chat, so if you want to add more, please do. But Jacob, I guess we all are wondering then, so why should we increase the EM allocation? What will make it turn from not performing as well as developed market this year to outperforming?
Yeah, I think it's what I said in the beginning, right? You just need to see this geopolitical noise somewhat fading. Investors will turn to fundamentals, and if they do, then I think it's a no-brainer that emerging markets and China will perform. You know, when that happens, to what extent, it's hard to tell, but I think somewhere now is probably a point to start dipping your toes or start making some smaller allocation towards emerging markets.
Indeed, and it is where you have most of the growth in the world as well, so not a bad argument as well. We have here a question: how are you positioned country-wise right now, and perhaps most interestingly in China?
Yeah, so our approach has always been country neutral, or rather give or take country neutral. If we really don't like a country, we don't need to invest in there. But it's hard to say, you know, will China be the star next year, or will it again underperform? I mean, I really can't make that judgment call. I mean, fundamentally, it's very cheap. This is where you have the growth. So this is why we're staying quite country neutral. We instead focus our time and energy on finding the best stock picks. So this is how we do it, and I don't think that will change.
Actually, I see it's time flies here. So do you have any kind of final words to tell our listeners at this stage? We need to close quite soon.
No, I think we'll get back next time probably with some more stories from the ground here, traveling around to the different provinces of China, traveling around to other destinations in Asia, and hopefully also a little bit of good news, or at least no news on the geopolitical front.
Excellent. Thanks a lot, Jacob, and thanks a lot everyone who's been listening into this one, and see you all soon. Bye-bye.
Thank you.
you.